ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Hello, good morning, everyone.
Good morning.
Good morning, doctor.
Yes. How is your morning?
It's good.
Okay. So welcome to today's class. Just want us to pick from where we left last time. That was yesterday, and this was about variance analysis. And we looked at the various costs that we can establish, compare the standard cost or the budgeted cost against the actual cost that are realized. And then we did illustrations for material cost variance and for labor cost variance. And under the material cost variance, we did material usage variance. We also looked at material price variance. And then under labor wage variance, we also looked at the labor hours variance, and the other one is labor efficient variance. Then other than the labor and material, we also have the overheads, and we realized that under overheads we have variable overheads and we have fixed overheads. I assume by now we should know the difference between the two. Variable change the level of output or level of activity, and fixed do not change with the level of activity. So
Doctor. Hello, doctor.
Yes.
Hello, doctor.
Yes.
Please tell all students to mute their mic. There is a disturbance.
All right. Please, all of us, can we mute our mics? Mohammed, can you mute mic? Good. All right. Thank you. So sorry for that interference, but I was just bringing us on speed with what we did yesterday. And And we were now to look at the overheads, which is our area of discussion today. And then after that, we'll finish up with the sales variance, And you realize that with sales variance, we normally look at the results in the opposite direction than the way we are looking at costs. Because costs, if we are spending less, that's a saving to the company. And if you are spending more than what is budgeted or what is the standard, then it's adverse to the company. But for sales, if you are selling less, that is adverse to the company. But if you are selling more, then that is a plus to the company. So we look at it, the interpretation that we give to the results it changes when you look at sales, other than when you are looking at the costs. So let's go through the slides as I'm going to share this. Then after that, we shall have an area for open discussion just to see whether we are on the same page. Now, we are basically going to use the same table that we had yesterday, and we are just going to continue using the same figure that we have that we are using yesterday to address the illustration on costs, overhead costs, and then on sales, because we had been given all the information that we require to compute the specific variance for the overhead costs and for sales. So given the same table and information that labor hour rate is used as a basis for variable cost. Now, here, this information is very important because we are saying variable costs change with the activity, with the level of activity. So, so for you to allocate the variable cost to the production, then it must be having a basis under which we are allocating the variable overheads. So in this case, our basis for allocating overheads is hour rates. So we are going to use the hour rates to the labor hour rates to apportion our overheads to the production. And then the figures are the same like what we were using yesterday. So we have the overhead, the variable overhead variance. So what is variable overhead variance? Variable overhead variance arises when there is a difference between the actual variable overhead and the standard variable overhead based on budgets. So so we have budgeted some overheads, but again, there is that one we have spent because probably the activities level changed, and then as from the budgeted to probably another level, therefore this one are also bound to change. So how do we determine the variance for that? Then variable overhead variance formula is standard variable overhead minus actual variable overhead. Now here you must understand the apportionment basis, the basis under which you are using to apportion this cost, the variable cost. And here we are told clearly that we have to use the labor hour rate. So that is what you're going to use to apportion the overheads. And so if you are to determine the standard variable overhead, less actual variable overhead, so the standard is actually, or standard rate minus actual rate times actual output. All right. So this one, if you have the total costs, then you just take the standard overheads minus the actual overheads. But if you are given the rates, like in this case, you are told to use the rates, then we have to use this second formula. The standard rate minus actual rate, standard rate minus actual rate times the units, actual units output. Okay, so that is what we're going to use, because here we've been given the rates and we have not been given the total figures. So we use the rate, the basis which you've been told to use to determine the variable costs that were actually utilized. Now, variable overhead variance is divided into two. We have the variable overhead efficiency variance, and then the variable overhead expenditure variance. Just like labor, we had efficiency and rate. So here we have the efficiency variance overhead, and is given as actual output minus standard output times standard rate. Actual output minus standard output times actual rate. And then the variable overhead expenditure variance is given as standard output times standard rate minus actual output times actual rate. So determining these variances is it's not that hard. So just using the same table, you need to determine the following. One, the variable overhead variance. Then two, the variable overhead efficient variance. And then three, the variable overhead efficient, expenditure variance. Now you realize if you are to use initials, we have to be specific. Which one are we looking for? So that's why we have EF. EF means when you see EF, it means efficient. And when you see EX, it means expenditure. So that we differentiate between the two, all right? So if you are using the initials for efficiency, we use VOEFV. But for expenditure, we use VOEXV, just to differentiate between the two, all right? So the solution to this illustration, number one, now variable overhead variance is given as standard rate minus actual rate times actual output. We saw, because you have been told to use the rate, then this is the appropriate formula that we can use to determine our variance. So from the table, our standard rate and actual rate, and then the actual output. So our actual from the table, standard rate is 8. You can see the labor hours rate, which is our total, is 8. The actual is 7. All right. All right. And the output is 80. The actual output is 80. So when you come here, you take 8, which is standard rate, minus actual rate, which is 7, and then times 80. 80 is the output, the actual output. And then now you get your total. This is 1 times 80 gives you $80. So $8 is favorable because the 80 is the standard, and we actually spend 7. Sorry, the 8 is the standard, and we actually spend 7. Therefore, we had a saving, and that is favorable for the organization. So this is favorable. That is the interpretation you can give. It's a favorable state. Then to number 2, variable overhead efficiency variance. Variable overhead efficiency variance. We've been told it's actual output minus standard output times standard rate. So actual output is 80, and our standard output was 100. If you can see from the table, 180. So 180. So this one will give us 80 minus 100. That is that's negative 20. Negative 20 times 80, that is 160, negative 160. So negative 160 is unfavorable because, of course, this is a negative, and you can see our actual was 80, but we ended up, our actual was 80, but the standard was 100. And then now, actually this minus this times this, you get negative. So negative is unfavorable when you are talking about costs. For variable overhead expenditure variance, we are told it is standard output times standard rate in bracket minus actual output times actual rate. So standard output is 100, all right. Standard rate is 8. We saw that the standard rate is 8. This is the labor hour rate, which we have been told to use. And because we are analyzing the variable overheads, then we have to use that. And then minus the standard, the actual output is 80 and the actual rate is 7. So when you multiply these, all right, you get 800 minus 560. 560, you get 240. 240 is favorable because your answer is positive. Your answer is positive. All right, so this is favorable. It's a saving to the organization. So that is about the variable overheads, and you can see how we are devising favorable or unfavorable after determining the variance, and then whether it's variable or whether it's favorable or unfavorable. Okay, so now back to fixed overhead variance. Now fixed overhead variance, this one arises when there is a difference between the standard fixed overhead for actual output and the actual fixed overhead. Now this one, fixed overheads do not change with the level of output. Then they remain unchanged, whether we produce more or we produce less. So somehow we have to incur the fixed cost. So the formula for fixed overhead variance is actual output times standard rate per unit less actual fixed overhead. All right. So it's also further divided into two. So we have the fixed overhead expenditure variance, which is given as standard fixed overhead minus actual fixed overhead. Then we have fixed overhead volume variance, where we have actual output times standard rate per unit minus standard fixed overhead. Now, if you go back to our table, you can see fixed overhead. We have the fixed overhead rate per hour. So this one you're given, it's already determined for you, rate per hour. We have the fixed overhead rate per unit, all right? And then we have the fixed overhead totals, all right? Which is standard is the 3,000 and the actual that we spend is actually 3,500. So you just pick from this and then you fill up the formula. So with the same illustration, we are asked to determine the fixed overhead variance, the fixed overhead expenditure variance, and the fixed overhead volume variance. So if you to get a solution for the fixed overhead variance, we have been told is actual output times standard rate per unit minus actual fixed overhead. So actual output is 80 times 30. Now, the standard rate is 30. The actual output is 80. We know that because that was 80 kilograms. Sorry, 8 kilograms, 80 kilograms. And then 30 we've been given from the table. All right. So if you look at the table, you can see the 30 is here, the fixed overhead rate per hour. Sorry, per unit, not per hour, per unit, because we are talking about now the product. In that case, it will be 80 times 30, then minus actual fixed overhead, which is 3,500. So when you work out this, you get negative $1,100. $1,100 is unfavorable because this is negative. This is negative. Okay. So 80 times that is 2,400. So 2,400 is actually less than the 3,500. So when you minus, you get a negative. So that is unfavorable. Then we have the fixed overhead efficient variance. It's a standard fixed overhead minus actual fixed overhead. Our standard fixed overhead was 3,000 from the table. And then the actual was 3,500 from the table. So the difference is 5,000, and this is unfavorable because you can see 3,000 is less than 3,500. The difference is negative, so this is unfavorable. Then we have the fixed overhead volume variance is given as actual output times standard rate per unit minus standard fixed overhead. So our actual output was 80 from the table, and then our rate is 30, just like we did here. And then this time around, we are lessing the standard fixed overhead, which is 3,000. All right. So the difference is 600, which is negative. This is negative because when you multiply this, you get 2,400. 2,400 minus 3,000, you get a negative 600. So the negative is unfavorable. So that is the state of these results is unfavorable to the organization. So this is how you just determine this. All you need to know is which formula and the rate that you're supposed to use based on the information that you've been given by the examiner. Otherwise, there's nothing difficult here. Is the issue of interpreting the result is just if it's terms of cost, if the answer is negative, then that means it's unfavorable. If the answer is positive, then that is favorable to the organization. Now, the next variance is sales variance. And as I had said, this one now changes, the interpretation changes. When it is negative, when your result is negative, then that is favorable. And when the results are positive, then that is unfavorable to the organization. Because remember, we said we always start with the budgeted or the standard. And then now we compare with the actual. So for sales, you expect always it's good to surpass the standard. So that's why we are saying when you have surpassed the standard or the budgeted, then we are doing well for the organization. So you will expect a negative result, and a negative result is favorable to the organization. So it's just the opposite when you're looking at sales and when you're looking at costs. So sales variance is the difference between the actual sales and the budgeted sales of an organization. The actual and the budgeted sales of the organization. So sales variance formula, we have the budgeted quantity times budgeted price, all right, minus actual quantity times actual price. All right. Then we also have two subdivisions of sales variance. We have the sales volume variance, where we consider the budgeted quantity minus actual quantity times budgeted price. The budgeted quantity or the standard quantity less the actual quantity times the budgeted or the standard price. Now, sales price variance is also another division, and this one is determined by taking the budgeted price minus actual price times the quantity, the actual quantity produced or realized. Now, there's something also important to note here. Here, we are working with the assumption that all units that were produced were sold, all right? But you may have a situation where not all units that were produced were sold. So if you have to be keen, if you are told we had some closing stock that were not sold at the end of the period, then we'll always reduce our output by the closing stock or the stock that we have at hand, which are unsold, to determine the stock that has already been sold, and that's what we need to work with. So this is something that you need to note. The situation when you'll be told some of the goods that were produced were not sold at the end of the period, so you have to factor in that so that you only consider the output that was sold to determine the sales variance. Okay, I hope that is clear. So having these formulas, we can now determine the following variances, and of course using the formulas to determine the following variances. We have the sales variance, we have the sales volume variance, and we have the sales price variance. Now, the sales volume variance, you've been given our formula there, is budgeted quantity times budgeted price, budgeted quantity times budgeted price, and then minus actual quantity times actual price. So budgeted quantity was 100, and the budgeted price is 50. If you look at the table, you can see our budgeted price, sales price per unit. Our budgeted or standard is 50, and then the actual is 65. So basically, these are the prices that you're going to use as our rates, our price rates. And then the output is 100, which is standard, and 80, which is actual. So that is what we are using here. The 100, which is standard, times 50, which is the standard price, all right, minus actual quantity is 80. We realized 80%, so our actual output is 80 times the actual price was 65. From the table, we saw that. So when you work out this, you get 5,000 minus 5,200. So this one is 200. The difference is 200, and it's negative. You can see 5,000 is less than 5,200. So the 200 is negative, and that's why we are saying it's favorable to the organization. Because this is sales. So you always have to understand what are you interpreting. which results are you interpreting? Are they in relation to sales or are they in relation to cost? So if they are in relation to cost, then this one would have been unfavorable. But because we are relating to sales, then this is favorable because we have a negative. Simply, it means that we had budgeted for 5,000 sales, but we ended up making sales of 5,200. So which is good for the organization. And that is actually the essence of this analysis that you're doing. Now, we have sales volume variance, and we've been told it's budgeted quantity minus actual quantity times budgeted price. So the budgeted quantity from our table we saw is 100 minus the actual quantity is 80. This is 80 that we realized, and then times the budgeted price or standard price. Standard price we saw is 50 from our table, is 50. So when you work out this, is actually 20, because this minus this is 20. So it's 20 times 50, you get 1,000. So 1,000 is positive, You can see this one, if you less this is greater than this. So this is positive, 1,000, and therefore our results are unfavorable because we are analyzing the cells. If you are analyzing the cells, we said if it's positive, then that is unfavorable to the organization. Then the sales price variance, we have the budgeted price minus actual price times actual quantity. So the budgeted price was 50 and the actual price is 65. So the actual output was 80. So 50 minus 65 is is 15. Huh? Is 15, negative 15. Negative 15 times 80, you get 1,200, which is negative. 1,200 is negative because 65 is greater than 50. So this is negative, and because it's negative and we are analyzing cells, then this becomes favorable. I hope you get the difference in terms of interpretation when you're looking at cells and when you're looking at costs. So this simply means we had set a price of 50, but we ended up selling at 65, all right? So we are doing better for the organization because we have increased our profit margin than what was anticipated, all right? So this is actually what entails. It entails in variant analysis, but it does not stop here. Now, like managers, it goes beyond this, because now this is where now you need now to realize which points to focus on and search into the reasons why the state is unfavorable to the organization. All right, the state is unfavorable to the organization. So you look at the various factors that may have contributed to the unfavorable state. All right, and then now see how you can improve on them, or how you can control them, or how you need to put more emphasis in terms of management of certain areas that involve the process of sales and the process of costs. So, so that is what I can say about variance. So I think the remaining thing is about this is just doing some more illustrations so that we get to appreciate some of this variance analysis. But now the interpretation depends on a specific situation you're looking at. You need also to look at the various external factors that may have contributed to this. Like, for example, if the price is 50, we had budgeted for 50 and ended up selling 65, what could have happened to the market, because this is actually basically dealing with the external market. It's not internal, because if you can sell at 65, why, what may have contributed to that, all right? To our price going up than what we had planned for. And let me get your feedback on this before now we agree on the way forward. So any comments, questions about variance analysis and the interpretation of the results? Hello, are we together? Are we together? Yes, Bekele.
Hello,
Bekele,
sir.
come on. Yes, yes. Yes, yes. Bekele, yeah. I can't hear you. Yes, yes. Mabale?
Okay, are you listening me now?
Yes, yes.
Okay.
Yes.
It's regarding overhead, fixed overhead variance. I don't have issues with the calculations, but why are we doing this? The basic purpose. Why are we doing the analysis? What do we intend to find? Have you got me? I want.
You're asking
your reflections.
Why do we
do the fixed overhead variance analysis? What do we get? What do the results tell us?
The results of doing fixed overhead variance.
What does that tell us to our decisions in management? Thank you.
Okay, thank you for that question. Anybody who can assist our brother here, who can respond to that? Why do we have to do analysis of fixed overhead variance? Hello? 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 Hello, are you with me? Johannes, can you hear me? Hello?
Yes, I can hear you, Doctor.
Okay, okay. Now, Bakele had asked a question on why we do analysis for fixed overhead. Why do we do analysis for fixed overhead? Can you respond to that? Or anybody else who can respond to that? Why do we do analysis for fixed overhead? Yes.
Doctor, can I help?
Yes,
can I come in?
Yes.
Okay. This is Mohammed.
Mohammed, yes.
Yeah, thank you, Doctor. I think, especially in production and sales, we need to have a very good information about what we are producing and what we are selling. For a single product, when we have various products, for a single product to know whether it is profitable or not, whether it is going according to our plan or not, we need to have a cost for this analysis for each and every single product. So in management, it will help us to decide which one to continue, which one to stop, which one to increase, which one to decrease, and in which level our performance, to know in which level our performance is. And I think this help us by this analysis. Thank you.
Thank you. Yes, Mohammed, that's a good attempt to respond to the Kayla's question.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ MBA በስትራቴጂክ ማኔጅመንት፣ MBA በባንኪንግ እና ፋይናንስ፣ MBA በቢዝነስ ሊደርሺፕ፣ MBA በሪስክና ኢንሹራንስ፣ MSc በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
And I liked what Mohammed gave. Was it Mohammed? That we should be aware of all costs that you are incurring as you are doing the production and selling, because this matters a lot in the decision that we have to make and to remain relevant in the market. Because if we ignore the overhead costs and yet their costs, they play part and parcel of our costing process, then that will be wrong, isn't it? So we have, we talked about cost accumulation. Cost accumulation, we have to consider all costs that we are incurring, all right? We have to consider all costs that we are incurring so that we can determine we can give a proper estimate of the cost of every product that you're giving. So we can't ignore the overhead, the fixed overhead, because we should incorporate them as we determine the cost of the production, because they have been incurred and they are supposed to be absorbed within the production process. So that's why we have to analyze them as well, because if we ignore them, then when we are doing our pricing of the product, it will be misleading. We will not have incorporated all costs that were incurred to bring the product up to where it is before it's being sold. So it's important that we collect all these costs, including the fixed overhead, because they contribute towards the production of the product. And that is the only way we can ensure that we are covering all the costs as we are doing the pricing of the product before it goes to the market. Otherwise, if we ignore the overhead costs, then you will undercost your product, and therefore undercosting your product, when you load on the profit margin, you will not have even covered all the costs. So that is a dangerous if you leave out the fixed overhead just because they are fixed. It's always important that you consider them for the sake of pricing of our product. Okay, so it's important that we also analyze them in relation to the variance analysis, so that we see even them how they are affecting the units of product, because there are some units. I mean, despite the fact that they are not changing, but we can always apportion to the units of product. Like if we know the units of product are 80 and we have incurred the fixed cost, we are incurring fixed cost of 3,000, then you just take 3,000 divided by 80 so that you get the cost per unit of a fixed cost, isn't it? So that is very important so that we do proper pricing as managers and we can manage all our costs accordingly. Getachew, yes? Getachew? Yes, Getachew? Yes, come on. Getachew? Speak up. I can't hear him. That is Adunguna. Getachew. Speak up.
Hello.
Yes, good. Can hear you. Yeah.
Just follow up to the previous question.
Yes.
Which aspect of the fixed overhead? Which aspect of the fixed overhead cost is important to make managerial decisions? Because most of our decisions are highly affected by the variable overhead cost than the fixed cost. So which element of the fixed overhead cost is important to make a decision? Thank you. Over.
Okay. Which element of the fixed overhead cost that is relevant for decision making? Who can respond to that? Which element of fixed overhead is considered for decision making? What are fixed overheads to start with? Gerachew, how do you understand with the fixed overheads? Gerachew? Yes. What do you understand with the fixed overheads? What are fixed overheads?
As general understanding on my side, it is fixed that may not change as we go. Yeah. Very rough understanding could be. Okay.
Okay, but there are also costs that are incurred for purposes of production. Assuming you are paying rent for a production department. It's a production department and you're paying rent for that. You know the rent that you're going to pay, isn't it? And you know, I'm just giving you a typical scenario. You know the rent that you're going to pay. Whether you're producing or not, you have to pay the rent, isn't it? So that rent is towards the premise that you are occupying for production purposes. So if we don't incorporate this rent we are paying for that corporation, that department for production, or the premises for production, if we don't load on, you see, the decision that may come, the part of decision that may come here is, for example, you can negotiate with the landlord about the rent, isn't it? Or you can decide to shift to a cheaper premise. If you find that your rent is just way above the whatever you are producing there, the benefit, the cost benefit analysis, the benefit of production from there and the rent that you're paying, all right? So if you analyze in that manner, then the decision that you could make, you have to identify these particular items that our fixed overheads are going towards. And I'm saying, for example, rent. So what are you going to do about this rent? If it's eating too much into your profit or your product, because it's how if you know the rent that you're paying and you know that you're producing these units, it's a fixed rate, isn't it? It's a fixed rent. But this time the level of production has gone down. You see now that rent that you're paying is fixed, but it has to be loaded on the cost of production, so that whenever the units are moving from there, they have the component of rent of the premise that we are talking about, which is fixed. So decisions like deciding to relocate, decisions like negotiating with the landlord about the rent, decision like those are now decisions that you can make, because you can see the contribution of fixed overhead onto, the total cost of a unit of product. I'm just giving that as a typical scenario that you can appreciate why you have to do the fixed cost analysis, variance analysis, so that you can make decisions like relocating or outsourcing, so that we don't have to pay rent, we just outsource. Those are decisions that can also be considered in terms of the fixed overhead that you are incurring for production purposes. So you don't include the rent that you're paying for the premises you have hired for production purposes just because it's fixed. It is fixed, yes, but you can always allocate on the units that you're produced, so that it's part of the costing that you're doing for that particular unit of a product. Because at the end of the day, it has to be paid, right? It has to be paid. So those decisions are done so that we make the essence of decision making is to minimize costs, isn't it? As much as possible. So why pay this rent when there are other alternatives, isn't it? So you can also consider other alternatives other than just paying rent when it's contributing a lot onto the cost of this product of item. I don't know if that is making sense to you, Rachel. All costs
Very
have to
much.
be analyzed.
Yeah, very much appreciate. Well explained with the scenario. Thank you.
Thank you.
All right.
Any other question? You have another question, Gerashel?
Then
Okay.
over to you. No, it's over to you.
Okay, thank you.
All right.
Now, who can explain to us a scenario where we planned to sell our product at 50? That is the price, the selling price, that is the budgeted, but we end up selling at 65. What may have contributed to that? What are some of the factors that may have contributed to that? Because I remember somebody asked yesterday, if it's favorable, we tend to ignore and assume everything is okay. So that's why we have to appreciate when it's unfavorable, it's also as good as looking into it as looking at favorable states. So I'm giving an example of a situation where we had planned to sell at 50, but we ended up selling at 65. What are some of the factors that may have contributed to that? A proper manager is a manager who looks at both scenarios, isn't it? So that you keep appraised.
Can I come in, Doctor? Can I come?
Yes, Mohammed. Yes.
Okay. One of the reasons might be that there are no more competitors in the market for our products which we come to sell. And the other reason may be that our product is being sold with a low price in consideration with other products.
Yeah.
In consideration with, I'm telling to my kids to keep silent. So the other reason maybe that our product is being sold less than the average market, because when the price is lower, it's usual that the customer may prefer our product more than other products. One of the reasons, as I told you, as I speaking before, is there may be not more competitors in the market. And the other reason maybe our product is sold with a lesser price in the market. Maybe probably the consumers or the customers may prefer our products than other products for quality or other reasons. Thank you, Doctor.
Thank you. Yes, that is a good factor that can be can have contributed to the price being more, the selling price being more than what we had budgeted for. All right. Yes, Getachew? Getachew, yes?
Yeah, as a manager, we have to also look into the external environment, like for example, the macroeconomic environment within the country or the region where we operate. Like, is there any inflation in the economy? Other thing is how you may also set unnecessary price in the market because of the nature of your product or service. Like, we have to understand also the structure of your own company. Is your company a monopoly, oligopoly, or operating in a competitive market? So we have to look into also the external market situations, including the macroeconomic issues and global aspects as well. Over to you.
Thank you. Thank you. Yes. So you have also to look at the global aspects, and for example, issues like probably the exchange rate. If you are using another currency, like you could be you could be selling your goods in dollars, but you find your goods are now when you exchange, you find it appreciated. It's getting better than what you had planned for. And then issues to do with probably you may not have done a proper market survey before arriving at the price. All right, so you also need to do at some point. It's important that even if you are selling high, you also need to carry out some market survey and see how people the attitude of people towards your product. Because pricing is a very critical thing. You don't just because it has a message. Pricing has a message to the consumer. There are those who, when something is highly priced, they also associate it with the quality. All right. So probably the quality is high, and people are ready to offer than what you had planned to offer. So that also contributes to that. So market survey actually is part and parcel of pricing process. All right. So it's only not just the cost and the margin, the policy margin, but also the market. How does market value your product? All right, the general value of market in your product in the market. So this is important things that you need to carry out after some time, so that it can also inform your decision as you make also on the other side of costs. All right, because as much as we have to make decisions regarding the sales, the costs are also affected in one way or the other. Or the decision that you have to make with the costs, the sales are also affected in one way or the other. So we cannot just link on one side and forget about the other, because the two are actually, when you bring together the two, that's when you realize the profit. But you cannot pursue one and at the expense of the other. So both of them have to be pursued. That's what I can say in the bottom line, because You cannot just focus on sales and forget about costs, or focus on costs and forget about sales, because if you have to achieve higher profitabilities, then you have to consider both of them, because the outcome of both of them is now the profit you're talking about. So I'm assuming we can now appreciate the variance analysis of costs and then of sales, and then we can also even do for profit. But you know, now profit is actually the cost and the sales. So profit is sales minus cost. So, but that is much going to be addressed in the CVP analysis, the cost volume profit analysis, because that's another area we're going to after this. Next week, I will want us to do more of illustration in this area of variance analysis, because this is where the managers come in handy. But as much as you are looking at this, what are the possible alternatives that you can offer in a situation where, for example, we have material usage costs being unfavorable to the organization? What are some of the alternatives that you can offer? What are some of the things that you can suggest for the organization to do so that they can reduce this unfavorable state of material usage? All right. So as much as we do that, you also think about, as a manager, what are some of the alternatives that you can offer that may work towards reducing that unfavorable state for material usage. And that's where we come in handy as managers, because we have to offer solutions. Okay, we have to offer solutions. Okay, so I think if there's any question, you are free to ask. Anybody with a question? Okay, now what I'm going to do for next week, I'm going to share the illustrations that we are going to discuss, and precisely from this area. And I'll try as much as possible to simplify and even use a chalkboard, as it has been mentioned, so that we understand this and appreciate. And alongside that, we'll also be thinking of how we can offer alternatives in case where we find we have unfavorable state and favorable state. Segni, you have a question? A comment? Mohammed?
Thank you, Doctor. Thank you. It was a nice class.
Yeah.
Just one issue.
Yeah.
On the favorable and unfavorable. Sometimes it may be unfavorable but not negative.
Yes.
Doctor.
Yes, yes.
At unfavorable, the outcome might be unfavorable but not negative.
Yeah.
So it might happen, yes?
Yes. Okay. All right. Now, Mohammed, thanks for raising that question. You see, now, you cannot expect everything to be favorable all through. All right. But you always give room for unfavorable states. But now the issue is, what is the magnitude of the variance? What is the magnitude of the variance? If the magnitude of the variance is too huge, it means there's a lot of deviation from the budgeted figure. And those are areas that are now called for, it's alarming areas, isn't it? Those are now the alarming areas. So you also look, other than just the favorable state, the unfavorable state, you also look at the magnitude, the materiality of the variance. The more material of the variance, then that means that's an alarming area. So we focus on those material areas, all right? If you get a variance of, for example, $10, You know, that's so significant. That's so insignificant, isn't it? So we cannot focus on that. And when we have a variance of, unfavorable variance of $5,000, all right? So you will tend to focus on the $5,000 unfavorable than on $10 unfavorable. So we, as much as they are all negative states, we also go for the ones that are so material, all right? Otherwise, you cannot handle all of them. So you realize that as much as you are addressing this one that is so material, you'll end up even solving this one that is so insignificant, all right? So there are issues that coordinate. For example, particularly the variable costs, because those variable costs change with the units of product. So mostly change with the units of product. So those ones are the ones which we also focus on a lot, all right, other than just the materiality of the variance. So other than one factor that we need to consider is the materiality of the variance, okay? So if it is favorable and is so material, that also is alarming. Like if you find we had budgeted for our price to be 50 and we ended up selling at 100, that is an area that you need to focus on. It's double. Why? There's something that is wrong somewhere, all right? And remember we said in one of our weaknesses for variance analysis, it always starts with the budgeting. If the budgeting process was not very considerate, then you will find such a material deviations, all right? You'll find such a material deviations. So it always starts with the budgeting. How was the budgeting done? Was it considerate? Did it look into several factors that probably needed to be factored in as we prepare a budget? Because if you get a budget that is not well prepared, it was not all-inclusive, it did not cater for all the other factors, then that's when you find some of these huge deviations, and therefore we need to check on that. So there's a lot that we can talk about this variance, and it's it's a way of, it's an informative process on what needs to be looked into as the organization. Probably the problem is with the budgeting process, isn't it? So you have to check about the budgeting process so that did we budget properly? Are there things we ignored during our budgeting process which we ought to have considered? All right, so those are issues that call on for discussion and decision making. So thanks for that question. We more focus on the materiality of the deviation, the materiality.
Thank you.
Right?
Thank you. Thank you.
Any other question? Okay, so Morges, are you there? Mr. President?
Yes, Doctor.
Morges? Morges, I think it's not, okay. So I think we can stop there for today. And it was nice meeting you this weekend, and hope to meet you again in next weekend.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ ያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጉታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ICM ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።